As an investor, it can be pretty stressful whenever you see somebody else getting better gains than you. And with the S&P feeling like hitting all-time highs every other week, it doesn't really help you that much. On this channel, I'm not gonna lie, dividends aren't free money, but we do love our dividends regardless. We cover the ETF SCHG a lot. But today we're going to be going to the dark side of growth investing and looking at the ETF SCHG. And make sure to stick to the end of the video and I'll share whether I bought some SCHG this week or not. And before we get to the video, I want to thank all my channel members, Parker, Redwood, and Ritz. You get some awesome perks as a channel member and some really nice looking badges. Alright, let's get on to the video.
I like money.
Let's start straight from the source and look on Schwab's website. To start off, the expense ratio is 0.04%. That's actually really good, and that's pretty fine when it comes to an ETF. At least it's not 1% like YieldMax. You don't want to be paying a large part of your returns every single year, and especially if you're holding them for a long-term time horizon. That's an amazing way to lose a lot of money. The fund's goal is to track as closely as possible before fees and expenses, obviously, the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. Let's look at some of the requirements that the stocks in SCHG need to have to be part of the ETF. To start off, the size of the actual businesses. The companies in SCHG must have a market cap within the top 85% of the US large cap equity stocks. Liquidity. Stocks must meet the minimum liquidity requirements, ensuring that they can be traded easily without significantly impacting their market price. This means basically if one company crashes, SCHG won't crash completely as a result, unless there's one company out there that could possibly dictate the entire market. But that's besides the point. Growth orientation. The index specifically targets companies exhibiting growth characteristics such as strong earnings, growth potential, high valuation multiples relative to book value or earnings. Essentially, they're looking for pretty good businesses at fair prices and growing businesses. Diversification. The index aims for diversification among sectors and industries to reduce concentration risk. That's kind of an obvious. And all stocks must be listed on U.S. stock exchanges, ensuring that they're subject to U.S. regulatory oversight and reporting requirements. SCHG looks for characteristics like revenue growth, free cash flow growth, and a huge thing to keep in mind with SCHG as well is that they don't manually control some of the companies that they buy and sell out of. A lot of people are upset that SCHG sold out of Broadcom, but it was automatic. They couldn't manually keep it in. It would break the requirement. Currently, SCHG is trading at $93.30 per share. They currently, once again, I mentioned the expense ratio was 0.04%, very important in there. They currently have a dividend yield of 0.43%, but I think you're not investing in SCHG for the dividend, you're more investing for that total return. You could even own SCHD and SCHG for that kind of off-balancing effect there. The 52-week low of this stock was $62.15, and right now they're pretty much trading at a 52-week high. Who would possibly buy at these prices? Over the last 5 years, they've had a price return of 136.89%. That's not including total return, which has outperformed the S&P 500. Obviously, past performance does not guarantee future returns, and 5 years, in my opinion, is a short-term time frame. So I'd like to see on a longer-term time horizon how they consistently do against the S&P 500, but with the companies and characteristics that they have, there's definitely a lot of growth to be had. Here's the breakdown of SCHG by sector. To start off, nearly half of the entire SCHG ETF is in tech, making up 47.5%. That's absolutely insane, but it's really the Magnificent Seven that I think build up a lot of this. Communication is the next largest sector at 13.22%. Healthcare, we are healthcare bulls here on the channel, as some would say, at 11.78%. Consumer cyclical at 11.71%, financials, I like this a lot, at 6.36%, industrials at 3.58%, materials at 1.87%, consumer defensive at 1.7%, energy at 1.4%, real estate at 0.59%, and utilities at 0.23%. A lot of the more old, mature, and conservative companies are going to make up less than 0.21% of the portfolios in cash. So SCHG is going to be heavily impacted by the performance of tech, and it could create a great buying opportunity. Now, thankfully, if you are a bull in tech and you believe in a lot of these tech companies long term, look at them qualitatively, all that good stuff, then SCHG is probably a good option for you. Now, these companies are a lot more volatile, so there is a bigger chance that they could have a huge pullback. But I think that can create a great buying opportunity long term, honestly. It's not like one company could completely dictate their price action. But once again, if you're afraid of tech, this is probably not the ETF for you. Now, here are the top holdings and the percentage of the ETF. To start off, the largest holding is Microsoft, which I absolutely love here on the channel at 12.65%. Microsoft's such an awesome company. Next, Apple at 9.93%, Nvidia at 9.24%, so at least I get some Nvidia exposure. Amazon at 6.49%, Meta at 4.46%, Alphabet Class A and Alphabet Class C, making up about 6% combined. So you're investing in a lot of the Magnificent 7 if you are buying SHG. I like the exposure to a bunch of companies though that I don't personally own in my portfolio, companies like Broadcom, Alphabet, Meta, Amazon, Nvidia. At least I get to see some of those gains because I haven't bought those individually in my portfolio, so I'm very happy to see that. Eli Lilly and Co., Broadcom, I absolutely love this one. Say your prayers for Broadcom and SHG in the comment section. Tesla, and that makes up about 55% of the portfolio, those 10 companies combined. You can obviously see where the tech exposure is going to come from there. I think Microsoft's an awesome company, though, to kind of be leading the way. And I think Nvidia, you could call it overpriced, but it's an awesome company regardless. They're printing cash right now. Let's move on to the dividend, and currently the dividend yield is sitting at 0.46%, and their dividend growth has been very, very inconsistent, but you're not investing in SCHG for the dividend and the consistency of it. You got to view it as a bonus on top. Their last payout was 38 cents yearly, which was an increase from 2022, but I would assume because tech stocks did not do very good that year. Overall, though, we're not going to take a huge look into the dividend whatsoever here. It really is just a bonus and cherry on top. Over a long-term time horizon, they kind of have grown, but it's really remained flat and inconsistent over the years. Looking at the total return compared to VU, over the last 5 years, SCHG's outperformed VU by about 43%, which is absolutely wild. Now, once again, this is only a 5-year time horizon, and I don't have that Seeking Alpha sponsorship yet like Dividend Dude, so I can't look at the 10-year or maximum returns. But overall, pretty positive thing to see here if you're looking for outperformance. Another huge thing to keep in mind as well with SHG is that tech has done absolutely insane over the last decade, and who knows if this kind of growth is going to continue. I can't predict the future, so I don't know if they're going to outperform the next year, 5 year, 10 years, or whatever. But hopefully, over the long term with all the requirements, SHG is set to slightly outperform VU or SPY. Now, will it be by 40%? I don't know, but you could see some solid outperformance with SHG. Now, you are sacrificing that dividend, obviously, if you're a dividend-focused investor there. But for somebody like me who would enjoy that total return and compounding over a long-term time horizon, it's a really solid option. Here's an interesting chart. This is the 5-year performance and total return performance of SHD versus VU versus SHG. And we can see, once again, SHG wildly outperforms SHD, but also VU as well. SHD, though, does have solid dividend growth and was outperforming in 2023, so that's a huge thing to keep in mind. This is a short-term time horizon. So as you guys know, I own SHD in my portfolio. It makes up roughly 8-9% of the portfolio at the moment. I recently just started my entry into SHG at around $92 per share. I obviously realize I'm kind of buying at the top and this could be a bubble, but I believe long term you don't want to try and time the market, and if it does have a pullback, which I believe it eventually probably will, I will gladly buy more. I'd like to go 10% SHD and 10% SHG, continue racking in my dividends from SHD, but also getting awesome gains and total returns from SHG to offset that from SHD. I hope you got that in. It gives me more exposure, and I love buying ETFs, and it's my second ETF that I've ever bought. I'd like to buy VU in a Roth IRA. Let me know your thoughts on SHG in the comment section, and let me know how much you own, if you do own any, if you plan to buy more, if you think it's overpriced. I'd love to hear. I want to also once again thank my channel members, Parker, Redwood, and Ritz. I greatly appreciate your support. It takes a lot of stress off my shoulders. Thank you guys for watching. Check out the Do Dividend Stocks Not Drugs merchandise. The link is in the description. Thank you for watching. Smash the like button, Do Dividend Stocks Not Drugs, and have a good one.